Hello, everybody. There's an issue with my video. I'm saying hello. Yeah, there we go. That's why I'm not going to show it right now. So hello, welcome to my overview, and this is for Wiley Chapter 3, or the income statement. My disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including, but not limited to, Irvine Valley College, South Orange County Community College District, or California State University at Fullerton. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. The questions that are shown or previewed in this presentation is copyright 2022 by Wiley, John Wiley and Sons. These questions are from the 18th edition of Intermediate Accounting by authors Don Kiso, Jerry Weingant, and Terry Warfield. My presentation is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Okay. So this is something I'm actually recording to release out to kind of put in front of the Wiley videos, just to give you a better context and what I would be covering in an intermediate accounting lecture for some of these different chapters. We'll see how quickly I can get, or how quickly I can make these, but we'll do our very best. So I never received permission. So Wiley was extremely generous. And that, I'm flickering. Like, this is like from Hot Tub Time Machine. Well, we'll see what happens. I was not given permission to use Wiley's PowerPoint presentations. And I generally, when I teach in class, I'll sometimes use them. But now more and more, what I do to teach intermediate accounting is I go to different publicly traded companies. And there's a reason for that. The reason for that is that when I'm talking with employers, the greatest thing that they will say that they wish more students had before starting at accounting firms was more exposure to SEC.gov. And so SEC.gov is the one repository where all US publicly traded companies have to go through and file their financial statements. So, again, I have a video that's up about how to go through and use SEC filings, and I'll put that video in the link below. But so the companies we're going to be viewing today are going to be, when we're studying the concept of the income statement, we're going to be looking at eBay, the Home Depot, Apple, Macy's, Snap, and Stein Mart. But before we get to that, though, first let's talk a little bit about the public reporting requirements, and this is for a publicly traded company. A publicly traded company, and what makes a company publicly traded? Well, if their shares are being traded on either the NASDAQ, NYSE, or the over-the-counter bulletin board, those are considered to be public exchanges, and therefore they have to make filings with the SEC. I'm not talking about foreign filers, which file different statements, such as, I think it's like a 6F or a 20F. That's for a foreign filer, meaning that they are based out of the United States. However, their operations are out of the United States, but their shares are traded here. So I think Alibaba is an example of one of those. But in any event, if you are a US listed, US based publicly traded company, you have to file 3 quarterly reports. And these are going to show you results for the first quarterly report is for the first 3 months. The next one is for the 3 and 6 months ended. The last one is for the 3 and 9 months ended. And these quarterly reports are reviewed. So when an auditor, right, when an independent auditor comes through, and when they're looking at the quarterly reports, they're not performing the same procedures as they would do on an annual report, or what we call a 10K. Now, if an auditor is going through and looking at this, it has to be a company that's registered with the PCAOB. That is the Public Company Accounting Oversight Board. And they're the ones who go through and regulate publicly traded companies. And if you go back and take a look at KPMG in June, I think it was of 2019, they were fined $50 million. The primary reason was because they were hiring former employees of the PCAOB to basically do better on their audits. Like, hey, which ones are being selected and their failure rate went down and they got in pretty big trouble. But again, the one audit report is the one that's going to be audited, is going to be that on the 10K. And one of the things too in intermediate accounting is you probably have just been exposed so far to the balance sheets, income statements, cash flows, and essentially the statement of retained earnings. But what's more important about the financial statements, as we'll kind of see, is that's really only part of the story. The real part of the story when we look at financial statements of publicly traded companies, a lot of time when you'll hear that term where it says the devil is in the details. Yeah, it's the details behind there. That's where you're going to really see a lot of the action. Okay, how does the audit process work? And again, I'm not teaching you auditing, but I want you to understand how this whole process works. So generally, if you are a company, if you have a bank loan, if you have investors, right? If you're publicly traded, and that's what we're going to be focusing on. But if you're publicly traded and you're on a senior exchange, such as the NASDAQ, New York Stock Exchange, you have corporate governance requirements. And one of these requirements is that you have to have an audit committee that is made up of independent board members, one of which on the audit committee has to be a designated financial expert. So they have to be very well versed in terms of financial reporting. What generally happens is that when a firm basically selects the audit committee will conduct a search for an accounting firm to be the auditor. There's a very important reason why you want the audit committee doing this, because they are independent members. It's not the CFO, it is not the CEO, but you want the independent members to select the auditors, to really preserve the sanctity of the process. So once the audit firm is chosen, right, and if you're dealing with publicly traded companies, you have to make sure that they are PCAOB registered. That's extremely important. The other part of this too is you're going to have, when you start this up, you're going to have with the auditors, there's going to be a pre-audit, pre-review meeting, or pre-review, pre-audit, pre-review, post-review meeting, post-audit, post-review meeting between the audit committee and, wow, my spelling's awful, and the board of directors. Also too, the auditors also must be independent at all times, as the financial statements are those of management. So when the audit is being done, the financial statements are those of management. The auditors are not preparing the financial statements. That is extremely important. Management prepares them, right? These are management's financial statements. So when we go through and look at all these different income statements, we're going to essentially be going through and seeing the income statements, basically their management's income statements. Now, one of the other things we've kind of seen before is just to kind of give you a little bit of a review. If we're looking at an income statement from financial accounting, right? And this chapter is dealing with the income statement and some additional issues related to it. You're going to see sales, less cost of goods sold gives us gross profit, less SG&A gives us operating income, other income and expense, income before income tax, income taxes, and then net income. And this is a traditional, what we call a multi-step income statement. So one thing you really will see is that income statements will vary from company to company. However, what you will see though is that there will be consistency in industries. For example, if I'm looking at the income statement of the Home Depot, it is going to look very similar to the income statement of, say, Lowe's. If I'm looking at the income statement of American Airlines, it's going to look very, very similar to the income statement of United. So within industries, you'll see a lot of similarities, but would I expect Netflix's financial statement to look like the Home Depot? And the answer is no, because they're in two separate industries, right? Netflix is a company that makes a lot of videos about serial killers, right? No, I'm just kidding. Well, actually, they kind of do. And then what else? So the other part of that is you also have, like Home Depot isn't, making content, unless it's probably security cameras from their store of people running out with stuff. Those are great stories. So let's take a look first at the Home Depot. This is really just to kind of give you kind of before we get into the more crazier ones. Let's take a look at the Home Depot. Now, for the Home Depot over here, and how did I get to this? How did I get to this point over here? Well, if I go to SEC.gov, and I look up company filings, what I can go over here and do is I can say HD. Does that mean high definition? No, it means the Home Depot. How did I know that their ticker symbol was HD? Well, if I say Home Depot stock price right over here, I'll see that it's at 270.94, right? So again, and the NYSE, that means the exchange that it's on. HD does not mean high definition. It means the trading, the ticker symbol. So when we come over here to look at the Home Depot, the first thing we're going to go through and see, and this is on a Form 10K, this is their annual report. We know we're at the right place because we see, oh, right, the big yellow thing or a big orange thing, the Home Depot. And we come down over here and you're going to see a lot of different information. And I really want to encourage you on your own to look at companies that you're interested in. If you like Tesla, read about Tesla, right? The more you do this as a student, the more it's going to pay off when you're starting your job. And in fact, what I generally recommend my students to do is that if you're saying auditing the Home Depot, if that's your client, I would actually get the financial statements not only of the Home Depot, but also of Lowe's and whoever their other competitors are that are publicly traded. Remember that companies like In-N-Out, right? Hopefully I didn't spoil or start any kind of or any necessary cravings, but companies like In-N-Out are privately held. They're not publicly traded, so we don't have access to their financial statements. But right over here, what you're going to see is over here, you'll see item 8, financial statements and supplementary data. And when we come down over here, you'll see the financial statements and supplementary data. The first thing is you're going to see the report of the independent register, that's PCAOB, registered public accounting firm. And you'll see over here that it was done by KPMG. They've been the auditor since 1979. This was done out of Atlanta, Georgia. With the Home Depot, the first thing you're going to notice is say, well, why do most companies have a 12/31 year end? However, for retailers, they generally like to use January 30th. Why is that? Is because returns after the holiday season will give them a better result in terms of what to actually go through and report. Accordingly, when you see their results, it'll say fiscal 2021. So even though their year ends in January 2022, they're just calling it fiscal 2021. So when we look at the Home Depot, and this is what's really important, this is their income from their operations, right? And if we look at this over here, we've got net sales, cost of sales, gross profit, operating expenses, SG&A, depreciation and amortization, total operating expenses, right? So what does operating mean? It basically means it's part of their operations, right? So it's their income from selling tools and toilets and showers and all that other kind of fun stuff. The cost of those sales, what do the inventory cost me to go through and do? That gives me my disgusting profit. No, it's the gross profit of how much did I make off of my inventory sales. I have my operating expenses, my selling, general, and administrative. So my selling costs, would be advertising. My general, what might be corporate insurance. Depreciation and amortization, that's going to be probably on store leasehold improvements as well as other equipment. So my total operating expenses, and then I've got my operating income. So this is what the Home Depot made from its operating income for the fiscal year ended, January 30th, 2022, or for the 12 months ended January 30th, 2022, or fiscal 2021. Now below here, what we're going to see is you're going to have other income and expense. And you see over here, interest and investment income. Well, this is not really, Home Depot is in the business of generating interest income. However, what Home Depot does have is they have cash, and that cash is going to be earning interest. When they say cash and cash equivalents, we'll talk about that in a later video, but that's basically, I think it's anything that's convertible to cash within 90 days. And so we come down over here, we'll see interest and investment income, interest expense. So we're going to use like this other income and expense for things that are really not a part of operating, but they're going to see, what you'll see is, interest, essentially interest and other investment income. That's going to come down over here. You're going to have earnings before income taxes, provision for income taxes, and then you have earnings. So this is going to be a basic way we have this set up. And then the other part of this that I don't really introduce my students to in lower division financial accounting is the concept of earnings per share. What are earnings per share? Well, this is my weighted average number of shares outstanding, like how many shares did I have issued during the year. And if I take this, divide it into my earnings, this is going to give me an earnings per share. This becomes a very, very important number for investors. And one of the reasons why is there's something called the price to earnings ratio. If we come back over here and we say HD stock price, you'll see that's at $270.94. And when we look at the PE ratio, this is at 16. What does that mean? We take the stock price divided by the earnings of the company, and this tells it's going to take 16 years to earn back the share price. Now, if we're looking at this in September of 2022, we've already had 2 quarters of information or financials that have been released. So this is going to be based on trailing 12 months. So you'll get close, but we won't get exactly there if we are going through and using, if we were to go through and say, use this number right over here. If you're saying, well, Bennett, if I divide that into 1559, why doesn't it work? It's because it's trailing 12 months. And the information we're looking at here is already stale, meaning that we've had 2 quarters since January of financial information. So that's essentially an income statement for a company. There is an assumption that whenever we see this over here from the Home Depot, this is their continuing operations, but we're not going to say it, right? We don't say it because it's just assumed, right? They're in the business of going through and doing what they do, which is selling, home furnishing products, lumber, and everything else to consumers. So this is the basic income statement. And this is, again, the earnings per share number is very, very important in terms of looking at and determining valuation. So now let's go ahead and take a look at something that's going to be new to all of you if you're studying intermediate accounting for the first time. What if we decide to discontinue part of our operations? Well, if we decide to go through and to discontinue part of our operations, this is generally going to be done by a board resolution of management. If we are going to discontinue if we are going to go through and discontinue our operations, generally what's going to happen is the CEO and CFO will come in, chief executive officer, chief financial officer will come into the board. They'll say, look, we got to get rid of this. Could be regulatory, like we have to get our business out of Russia, could be anything, right? So when we do that, right, we're basically going through and we have to make the business case. And it's very important that when this is not made arbitrarily. You have to come in and you have to show the numbers. You have to present to the board of directors. This is why we're discontinuing this part of our operations, because in Delaware, where most companies are incorporated, they have something called the business judgment rule. And that is going to protect management and the board in terms of making its business decisions. So management's going to go through and make the presentation. Now, once we decide to discontinue our operations, right? Remember with the Home Depot, we didn't say continuing or discontinued, we didn't say continuing operations because it's inferred. However, once we decide to come out and say we are discontinuing our operations, it becomes very, very different, right? So if we go through and we're deciding to discontinue operations, then this is going to impact the way that we're going to be going through and making our financial statement presentation. So when we go here and take a look at eBay, okay, so I'm going to show you 2 different ones. So eBay, this is the Home Depot, and this is the droid that I'm looking for. Perfect. Okay, so we have eBay over here for 2021, 2020, and 2019. And when you see this over here, they've got revenues, cost of revenues, gross profit, looks normal. Operating expenses right down over here, right? Product development, very important for us to see that a technology company is basically putting money back into R&D. Operating expenses, income from operations. And now what you're going to see is right over here, income from continuing operations. Why are we making this distinction? Because we have decided to discontinue our operations. We made the decision. We're going to stop this one part of our operations. So what we need to do is we need to signal, remember who we are making our financial statements for. It's for the investors, for the lenders. So we have to signal to those investors and those lenders, like saying, hey, this is our income from our continuing operations. This is at 252. Our income from our discontinued operations, net of tax, right? And why do we show this net of tax? It's because our income from continuing operations already has taxes taken out. So to make this number comparable to this, we have to show this net of tax. And I'll show you a few examples of this by a preview of the Wiley, or some of the questions in the Wiley book shortly. So we come over here down to our net income, right? So most important thing when you're going through and seeing this, if you have a discontinued operations, you show continuing operations first. Then we show discontinued operations, net of tax, because it's got to be comparable to this number. And that gets us to our total net income. Now, why is it so important that we highlight these to the investor? Well, if an investor saw that they made 13.6 billion without this disclosure here, they say, wow, eBay had a great year. This is like earnings of $20 per share. And eBay right now is trading for 38 bucks. Wow, that's amazing. They made like 20, that's a 2 times price earnings, right? But the reality of it is, as we go through and look at this for eBay, is that it's not really the case, because their current year earnings per share is only 39 cents, or from their continuing operations. So prospectively, it's not looking so great. And this could be a one-time payment that they got as a result of selling their operations. So when we have discontinued operations, right, again, we are making a very conscious decision as management to stop a certain line of our business. It could be for a variety of reasons. The country we're operating in has shut us down. We're selling something that's no longer viable. So we make that, we make that decision, and then we basically present this accordingly. Now, one of the things you're going to notice right over here is, let's take a look at 2019. This over here shows discontinued operations, right? And we'll just note this here of $2.10, or this 1.7 billion of net income. So what you have to do is, when you have discontinued operations, you have to restate prior periods showing that these are now discontinued. And I'll give you, let's take a look at the example. So for 2019, 1786, right? Remember that number, right? So over here, we had revenues in 2019, and this is from their 2020 10K of 8.2. This is a gross profit of 8.2 billion, but again, net income of 1,786,000. But look at these numbers here of 10,800,000 and 2.5 billion. When we go now over here to the current year showing 2019, you say, oh my God, Tchaikovsky, the numbers are different. Well, they are different because now when we're making the presentation to show the numbers so they are comparable, right? I have to show discontinued, this the same number, right? Net income is the same. This is exactly the same, 1.786 billion in 2019. This is also 1.786 billion. But if you look at this, the gross profit is now 5.8 billion. The gross profit here was 8.2 billion. So what we've done is we have to take out the discontinued operations from prior periods that we're going through and showing. So it's really important that when we go through and we decide to discontinue something, we're going to have to restate our prior results to show the effect. Now, the bottom line number isn't going to change, but the numbers are going to have to go through, and we're going to have to remove those components of the discontinued operations. So when we have it, right, not only do we have to go through and show it over here, net of tax, but we're also are probably going to have to go through and restate prior periods being shown so that the numbers are consistent now, or that they're comparable. Now, in terms of like, could I throw something like this on an exam if you're taking my class and going, dude, this is like, no, it is gnarly. Like you can't do that. It's on a test unless it's like I don't know, maybe I could do it. Who knows? But in terms of going through and, sharing it, it's like, oh, the reason why, again, this has to do with the numbers being comparable between periods. But once I decide to do it, I can no longer leave it as net revenues of this amount. I have to restate it so that it's consistent with or revise it so it's consistent with my current year presentation. You're not going to file, and actually I want to take that back or retract that. It's not a restatement. It's just basically a revision to make it comparable. A restatement is something else. Okay, so going back over here, right, we're also breaking out, so we're going to show this net of tax, but we're also going to have our earnings per share showing it between continuing and discontinued operations, right? So that's an overview of how discontinued operations look. Okay. So coming down over here to our next example, and this is something, when I teach this live, I sometimes don't get a chance to go through this because the discussion gets really interesting, but this is not something I'm going to test you on, or this is not something I would be testing my intermediate 1 students on, but this is something I am going to be mentioning to you because you will see this in financial statements. So I'm going to show you the financial statements of Apple. And as we look at Apple right over here, the reason why I'm going to show you Apple is I want to take a look at their balance sheet with you. So for Apple's balance sheet, what you're going to notice is that Apple has a very large amount of marketable securities. And you'll see this over here at 27 billion. Over here, it's at 127 billion. So of their balance sheet, roughly more than a third is investments. The rules are for investments is when we show investments on the balance sheet, it's not at lower cost or market, it's at current value. So what we have to go through and do is we have to basically take our balance sheet and we have to basically go through and say, okay, we need to show our investments at market. But the problem comes in as, well, wait a second. If we're writing up the value of an investment that we haven't sold, that is something we call an unrealized gain. And if I have an unrealized gain, do I want to put it directly in calculating net income? The answer is no, because it is unrealized. So you might be thinking, well, if I'm debiting investment, what do I credit? Well, we're actually going to go through and credit something called an unrealized gain. And what happens is below the income statement, you're going to see the statement of comprehensive income. This is not net income, but this is essentially a place which we go through and use to essentially balance our balance sheet. What you're going to go through and see is on the balance sheet, you're going to see common stock, retained earnings, and then you're going to see accumulated other comprehensive income or loss. What types of things go into this? Well, it's going to be things like unrealized gains and losses on derivative instruments or marketable debt securities. These is just another fancy way of saying investments, long-term or short-term, right? So we're not selling it, but we just have to adjust the value. We can't put that through net income because we haven't sold it yet, right? We're just changing the value. So instead, we're just going to put it here as part of other comprehensive income. Now, the other part of this too is, does a company like Apple do business in a lot of countries? And the answer is yes. They do business everywhere. And if I just do a quick find right over here, if I look at the revenues by reportable segment, you can see right over here, net sales, 365 billion. 153 is coming from the US, 80. So when we're going through and converting the sales from the local currency, which would be the euro, the renminbi, or the yen, to the US dollar, that's going to cause changes in terms of the currency rate. So what we want to go through and do is that's what's causing those foreign currency translation adjustments. And I really, again, If you take the time to go through this, I wouldn't be saying this to you unless I've heard it from employers, but the more time you spend on these publicly traded company reports, the better off you're going to be in the long run. Okay. So as we come here, that's an example of other comprehensive income. It's not something I would be testing my class on, but I'm just trying to make you aware of what exactly is this that's showing up at the bottom of the income statement, right? What does this mean? What's other comprehensive income? Okay. So the next thing we're going to go through and do is let's take a look at prior period adjustments. Now, one of the things that happens with a prior period adjustment is we may have to go through, we may find an error, right? And so if I come over here to, let's take a look, go back to Home Depot. So for example, if I find an error that took place in 2018 or say 2020, would I include it in 2021's results? The answer is going to be no, right? Why not? Because this income statement, remember, it's for the period ending, it's for the year ending. And let's go back to Home Depot. That might be better just because it doesn't have like the crazy fiscal year ended, right? So if I found an error in my 20, and if it's material, materiality means it would make a difference to an investor when they're going through and looking at the financial statements. So if I found a material error, say in 2020, that I'm preparing 2021, I find a material error, can I put that error through the 2021 financial statements? And the answer is going to be no. Why not? And it's because when I go through and I am showing my annual results, an investor thinks this is from the current period, right? This is what I made during the year. That's what the income statement is, or quarter, or whatever may have you. So that's what the income statement is. So if I put that error into the current period, I'm really not being, the numbers aren't, the numbers are wrong because it's not reflected in this period. So where do I put it? Well, if I looked at this company over here, and this is Stein Mart, right? This is going to be a great company for one of my students to look at in the future when I take a financial statement analysis class. Okay, so what you're going to see here is that when we have something, this is what we call a prior period adjustment. Again, what is it? We recorded something in a previous period, has an impact on our current year. So we have to go through and show this as a prior period adjustment. And if we look at this here, Stein Mart recorded retained earnings of $198 million. Okay, they had an adjustment for $17 million. Now, what you see is this as restated, right? So this number here, right, is the proper amount of retained earnings. So when we have a prior period adjustment, something that's relating to a previous year, what we have to go through and do is we have to show, okay, here's the restatement amount. Now, when we do that, let's think about this. When we show things coming into retained earnings, well, what goes into retained earnings is my beginning retained earnings plus my net income minus any dividends gives me my ending retained earnings. And by the way, the consolidated statements of stockholders' equity is a more expanded version of the statement of retained earnings because it includes retained earnings, but it's also going to be including things like common stock and APIC and then other accumulated comprehensive income or loss so we can reconcile out our shareholders' equity. So over here, when we show this adjustment, prior period adjustment, it's going to come down over here to net income, and then we're going to have our ending balance. And what's very important is we're going to say restated, and there's going to be a note here as described in note 2 to the financial statements. We have restated the consolidated financial statements. Now, how does this happen? Well, we could have a new auditor coming through the Securities and Exchange Commission. They will go through and review our reporting. There could have been a comment from an examiner who said, wait, what are you reporting over here? And why didn't you do it this way? You go back and forth with the SEC. By the way, it's always best to fully agree with them. Don't, if the numbers are what they are, that's why I would say not to argue with them. But you'll see over here, this is a restatement of previously issued financial statements. So when we have a prior period adjustment, this is going to show as an adjustment to the beginning retained earnings. It always has to be shown, though, similar to discontinued operations, net of tax. I have to take tax out of it, because if I don't, it's not going to be comparable to the net income, which already has the taxes removed. So keep that in the back of your mind as you're going through and looking at these different items. Okay, so coming over here, and this is where I'm going to kind of go through and take a preview. Now I have solutions. If you go to my playlists on my channel, you'll find solutions to all of these questions. But what the reason why I'm not going to do the questions, I'm just going to point out a few different things across it just to kind of give it better context. So over here, this is exercise 3-8. This is relatively straightforward in terms of going through and looking at, so here you've got net sales, cost of goods sold. And this question's a great one because it's essential. It's a good exercise because it's kind of basically you're kind of, well, what's the difference between, cash dividends declared and paid? You've got some prior period, you've got some depreciation expense, and then you've got discontinued operations before income taxes. So this is a great exercise because it's requiring you to go through and show things net of tax. And you're also being required to go through and show basically, your earnings per share. Okay, so this is, to me, this is a great question. And, I think it's definitely something that's worth going through and taking a look at. So great exercise. This one over here, again, this is dealing with going through and dealing, I didn't do this one in class, but this is something because I never have time to do all the questions in class. But this is over here. This is a good, exercise just in terms of going through. And this is, again, preparing a statement of retained earnings. What is the difference between dividends being declared versus dividends paid? How do prior period adjustments go through and work? And so this is also a great question to go through and look at. Okay, so over here, this one over here is exercise, basically over here, this is prepare a multi-step income statement, as well as going through and preparing a statement of retained earnings. Now, the reason over here why I'm going to show you this question, and it's not that Wiley is incorrect, but I want to show you that this can be handled different ways. The reason why I like this question is that over here it says, well, the write-off of goodwill. If we look at the solutions to the Wiley textbook, it's going to show it right over here as other income and expense, write-off of goodwill. Now, over here, when I look at Macy's, right, Macy's had a lot of goodwill at one point, but if we come down over here and we look at goodwill, and this is comparing 2020 to 2021, you see it was 3.9 billion. It's now 828 million. When we're evaluating goodwill, we evaluate it for impairment, meaning that has goodwill lost any of its value, right? So over here, we've impaired goodwill, why Macy's has a goodwill to begin with, but obviously this is pandemic time. So they clearly went through and did a pretty big evaluation of that. Now, in terms of how they presented this, right? So the goodwill was hit, right? So what they did was they didn't put it as other income or expense. Rather, they put it as part of their SG&A, or selling general and administrative, gains on sale of real estate, restructuring, impairment, store closing, and other costs. And what they may have kind of said is like, okay, this is really part of our operation. So we want to basically put this in here as part of our operations, because are we really now more of a real estate company versus a retailer? Like, how are we going through in terms of looking at our business operations? So I'm showing this to you here just to kind of say to you that, like when you look at a textbook, it's not always going to be correct. Going back through like that audit process is that management prepares the financial statements. Now, what can happen is the auditors can come through and they can say, hey, look, Macy's, you put this as other income and expense. but it really just should be part of like your SG&A. It's something you have to highlight it, but it really should come down against operating income because it's part of you're showing the impairment due from your operations. It shouldn't be part of other income. So that's something that, to me is very, very important. The other reason, so again, when you see the write-off of Goodwill, you could see it. It's not going to be shown net of tax, but you could see it. It could be if we were Macy's, we could show this as a deduction to get to operating income, or here we're showing it as other income or expense. Now, the other one over here, the reason why I'm also highlighting this question is I want to talk to you a little bit about preferred stock. When you are dealing, and this is really relating to publicly traded companies. If I look here at Snap or Snapchat, what you'll see here is you'll say, okay, I've got my assets, liabilities, and equity. Now, when we go down to stockholders' equity, what you're going to see here is like, oh, and this is for December 31st, 2016, 2017. Snap went public, I believe, during 2017. When we look at this over here, we've got convertible voting preferred stock, convertible non-voting preferred, convertible non-voting preferred, Series FP convertible, and then we have Class A non-voting. What you're going to see happen is when a company is a private company, they're oftentimes going to have preferred stock. Why? Because it gives a liquidation preference over common stock. And generally what's going to be happening is once a company becomes public, does the SEC want you to have multiple different types of, I would say, stock that has liquidation preferences? The answer is absolutely not. So what will happen is the preferred will generally convert into some sort of common. Now, for a company like Snap, and again, I'm more familiar with our friends at Meta Platforms. And what is Meta Platforms? Well, Meta Platforms is the old Facebook, right? They'll rebrand themselves in a few more years. They'll probably continue to go through and do that. But the reason why I like Meta as an example for going through and looking at companies is that when we look at their share structure, right, they've got Class A and Class B shares, right? What's the difference between these? Well, the difference between these is really has to be with the number of, how would I put it? It's essentially when you're looking at Class A and Class B shares, each of these have different voting rights. So the Class B shares, I think, have 10 voting rights power over the Class A, which is why, even though Mr. Zuckerberg does not have a majority ownership in the company, right? He doesn't own half of the value of the company. He does control the majority voting power in the shares, and the SEC doesn't really comment on this, or at least not right now. But the SEC does not really give a comment on this. And this is an important thing for you to know as an investor, because I could never vote Mark Zuckerberg out. Not that I would want to, but essentially this is how this part of it works. So again, when I look at stockholders' equity, right, you're only going to generally see common stock. When we go over here and look at Snap, you're not going to see two classes of common once a company goes public. Now, why am I going through this whole thing? This question over here, and if you're taking my classes, I'm not going to make you go through and calculate earnings per share when you have preferred stock, because technically the calculation should be your income from continuing operations minus any preferred dividends divided by the weighted average shares outstanding. That's the formula for earnings per share. But for publicly traded companies, you will generally never see preferred stock. I haven't really seen it. I've seen it once and then it evaporates once the company goes public. But again, from my understanding of how the SEC examiners come in and look at this, they're basically saying no go. So as you look at these types of questions, just know that in real life, well, you might have to do an earnings per share calculation if you're privately held with preferred stock, but generally that's not going to fly once you go public. So most of the time, the preferred shares will convert to common. So this part of this question would not really be applicable for publicly traded companies. So if you're taking my class, you're not going to see preferred dividends. And it's just because, again, I want to be closer to what you're going to actually be seeing when you're in public. Now, when it comes to the true earnings per share, which is later on in intermediate accounting too, oh, I have a lot of fun with that. We get treasury stock, we get, like convertible bonds, and like that's going to be more of a diluted discussion. But for our purposes here, this is basic earnings per share, which is all I would be asking you to go through and to do, is you would be going through and saying, okay, in this example here, you've got continuing operations. What is it from discontinued operations? And then you're coming down to basic earnings per share. Okay, so that's what that kind of goes down something similar to Home Depot. Well, this is more of a basic, but then you also have over here, when we have eBay, for eBay, you've got, when we're showing earnings per share, we have to show continuing and then discontinued separately as we talked about previously. Okay, so that's kind of an overview, and let's take a look at these other questions here. Problem 3-3, again, various income statement items. And this again is, how do we go through and show these on, prepare an income statement for the year ended 2025 with income before income taxes. So I kind of like this. And again, these are great questions. Over here, you've got multiple and single step income statement, retained earnings. And when you hear like what's multiple step income statement, well, multi-step is you're going through and you're showing, basically you're going through and showing sales, less cost of goods sold, less SG&A, total selling. Over here, you're coming down to net income. If I was doing a single step income statement, I'm just taking my revenues minus my expenses. That's a single step. Coming over here to exercise 3-5, unusual or infrequent items. Over here, again, you want to, if it's something unusual or frequent, we do not want to lump it in with SG&A. We want to go through and we want to show it. We want to show it separately in other income or expense, so the user knows that, hey, this is not really something that we're seeing all the time. Over here, let's see, that's problem 3-5, problem 3-6. This is also, so if we're changing accounting principle and we're not showing that current period income, that would be something that would be an adjustment that would also have to be shown net of tax. So I like this problem 3-6 just because it's kind of compelling us to go through and say, like over here, okay, like what is it? We've got our net income, what's adjust net income, as opposed to like what adjust for retained earnings. And we always have to remember to ourselves that we have to make sure that when we're adjusting, we have a prior period adjustment, it has to be shown net of tax. So going back to, let's kind of recap really quickly before we say goodbye, right? So biggest thing on this, and when we're studying intermediate accounting, we're really kind of learning about, we're going more in depth in terms of what we learned in financial accounting. So the concept of continuing operations versus discontinued operations. When discontinued operations are shown, they're shown separately behind continuing net income, so it has to be shown net of tax. Also, earnings per share is also going to be adjusted. When it comes to prior period adjustments, we don't want to put it in the current year because that's going to essentially distort our current year numbers, right? So what we want to go through and do is we're going to show that as an adjustment, prior period adjustment to retained earnings, and we're going to get down to net income. So in any event, I want to thank all of you for joining me here today. I'm making this publicly available, and I'm just so I promised, and again, I want to thank Wiley because Wiley has been very generous and kind in allowing me to create videos and then to make them public for my channel. And again, my criticism it's not really criticism, it's just that I like to deal with publicly traded companies. And so the way that I format my class is going to be different than, say, what a traditional textbook would do. So, but in any event, please don't forget to like and subscribe to the channel. If you would like to see other videos on certain topics, especially as it relates to intermediate accounting, feel free to either email me at 1812cpa@gmail.com or leave a question or leave a comment below. So I will see you on the next video. Have a great day.